Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. I am one of your co-hosts, Jamie Bateman, and today I'm joined by Bob Malecki, who has been in the real estate and note space for several years. Bob's out on the West Coast, in the Seattle area, I believe. Bob, how are you doing today?
I'm doing great, Jamie. Thanks for having me on.
Absolutely.
Yeah, I'm located near Seattle in Kingston, Washington, which is about 30 miles northwest of Seattle. So,
Okay. I imagine it's beautiful out there.
yeah, this time of the year, it's wonderful. We've got 70 degrees. Well, it's going into the 80s today, but sunny. And, the springs here are really nice because the Olympic Mountains get covered with snow. They're melted down now, but yeah, they just don't ask me in November when it's dark and cold and rainy.
Just try to remember today.
Yeah, exactly.
So, Bob, for the listeners who are unfamiliar with you, I know, I know you were on the Bigger Pockets podcast years ago, and you were kind of, for me, a kind of an inspiration as far as getting into notes. Actually, you were one of the first people who really well articulated the note space, or explained it well, and kind of really got me interested in notes, to be honest. So I've been familiar with you for a while now, but I know, many of our listeners may not be as familiar with you. So if you don't mind, can you kind of go over your background a little bit for us?
Sure. I was born in Cleveland. No, just kidding. Actually, I'm from Cleveland originally, but I traversed my way over to the West Coast in the late 70s or late 80s. And but I started in real estate investing in 2007. I had been running an internet company in the Seattle area. I sold the customer base and was still doing website development with a partner. So I've got kind of that techie background, and decided, around 2006, both my wife and I, both of our mothers died within a 12-month period and left us money. So we had some cash and we were trying to decide how to invest it. And I just decided, I read Rich Dad Poor Dad, and I was starting to catch up on real estate investing and figuring out what it was. Ironically, my father was a real estate salesman when I was a kid, so I'd spend Sundays with him at open houses in these new developments in the Cleveland area.
I'm familiar with that too. My father has been a realtor for many, many years, so
yeah,
I can relate.
Yeah, so we decided real estate was the thing, so we ended up buying a fourplex in Silverdale, Washington, which is about 30 miles away from where we live. And then a year later, we bought a duplex in Bremerton, Washington, and became landlords. Yeehaw. Kind of figured things out. And then a few years later, I heard about this thing called flipping. So I started to study how to flip a house. And, then we got into pretty much the 2008, 2010 housing crash. So there was a lot of good low-priced inventory. So I spent the next 10 years in that aspect, flipping houses in the Seattle area, mostly in Kitsap County, where I live, which is across Puget Sound from Seattle. You have to take a ferry from Bainbridge Island to get to Seattle from where I live. So I did that, and then in 2013, 2012 maybe, I was attending the local RIA group meetings every month and watching all the presenters talk about their courses and go to the back of the room stuff and all that. Getting my knowledge together, and this guy named Eddie Speed showed up and started talking about notes, buying distressed debt, and it's like, what the hell is that all about? And I kind of got bored and left. Didn't really see the logic in it at all. It didn't make sense to me, which really, when you talk to a lot of real estate investors who are doing traditional rental holds or flips, they don't understand what notes can do or the power of those. And then about a year later, the realtor who I've been working with, who's helping me resell my flips, she buys mobile homes. She buys land with infrastructure. She buys mobile homes. and puts the home on the land and then sells it generally to a blue collar worker at a good rate and all that. So anyway, she found a mobile home for sale, or not for sale, but she found a couple in Issaquah, Washington, that had sold their mobile home to another couple, and they took back a note, and they wanted to sell their note. They were moving to the Southwest and retiring. So I got connected with them and figured out that I offered them, I think, about 50 cents on the dollar. It was only a $14,000 note, so it wasn't a big acquisition. But I bought the note at 50 cents. And when I did the math, I figured out on the P&I payments, I was getting a 40% return. And I just went, wow, now I understand what this stuff's about.
Right.
I bought it in my IRA, so it was tax-free and all that sort, it's a Roth IRA. So I kind of got the religion, and then Eddie came back to the REITs group in Seattle to do another presentation. That's when I really got it. So, the fire was lit. I engaged in signed up for one of his weekend things where he and his crew came into a hotel, and we spent two days together learning about notes. And that really got me going. Excuse me. And I met my partner, Kevin Moen, there. Kevin was actually had enrolled in note school with Eddie and brought his mom along. So he was trying to get his mom to learn notes and so forth and so on. So Kevin and I got to know each other, and that was good. And then I decided it was time to start a private equity fund. I went to another weekend with Scott Carson at the time, and I met my partner, Ben Cote, at that conference. And Ben and I talked for about a year off and on the phone. So long story short, I grouped up Ben and Kevin, and I started Resolution Capital Management to buy distressed first position notes and so forth. And we did, and we're now winding that fund down because it was a 5-year closed-ended fund. So we're selling our assets and dissolving the fund itself. And we thought about starting another fund, but frankly, I don't think that we're going to see a recession. I think fairly soon, maybe in the next year or so, but I don't think it's going to be like it was in 2008. There's way too much equity in properties now for there to be a big pile of distressed debt like there was. So I've been buying notes in that. I also partnered with Josh Andrews and Scott Ruzich to do the Notable Capital Fund. And we buy 95% of the assets in the fund are junior seconds. Mostly performing first. So Josh is really good at second position debt, and he's been pretty much doing the heavy lifting in that fund. That's been a real joy as well. And I found that working with partners over the years really is great. I call it a three-legged stool. I do certain things good, but I don't do other certain things. So having two partners who complement my skills and I complement their skills really works out well.
Yeah. That makes a lot of sense. So
yeah,
there's so many different ways we could go with this. You've got real estate background, and then within real estate investing, it sounds like you've done a bunch of different things: fix and flip, buy and hold. Is that right? And so and it sounds like you've worked for yourself for quite some time. As far as when's the last time you had a boss?
Oh my, 1997.
Okay.
That's when I left it. I was working for Adobe Systems in Seattle, and they sold off the product line in the department I worked to another company, and they gave me the option of taking a severance or looking for another position in the company back in California. And I didn't want to. I was living in the Bay Area before I moved up to Seattle, and I really didn't want to go back, especially to Silicon Valley and all that craziness, the hectic and the traffic. So I took the pink slip, and that's when I started my company. I started an internet company on Bainbridge Island in 1999.
Okay.
I've been self-employed for about 22 years now.
So that's a good bit of time there. So we've interviewed guests who have done many different parts of invested in different asset classes or approached real estate and note investing in from many different angles. I think one of the things from at least from my perspective that sometimes may get lost is how much focus it takes or time devoted to one particular strategy Like we had Fuquan Bilal on a couple months ago, and he's done first, seconds, real estate, flips, notes, all kinds of things. But this has been over decades, and so just curious, like from your perspective, if you have anything to weigh in on that, as far as how to approach different asset classes or different strategies within real estate and notes.
Yeah, it's well, I mean, everybody's probably heard of shiny object syndrome, and it's
Hmm.
really easy to get distracted and, oh, what's this? And oh, gee whiz, maybe I should get into tax liens, or I mean, there's all kinds of ways to invest in real estate, as we know. And what I figured out, or at least determined for myself, is staying focused on one asset class at a time if I can, or maybe let them overlap. Like I was still flipping homes when I was buying notes, so it's kind of running in parallel to each other.
Hmm.
But I also knew that as homes appreciated, as our economy got better, that flipping is going to start not being as lucrative, and that's one reason I got into notes. And also, my standing joke is I just want to, as far as being a landlord, I just want a tenant who will send me money and leave me alone, and those are called borrowers. So,
Right.
so I
It's
figured out
true.
that I can create cash. I saw the value of notes as mortgage notes as being able to create cash flow with minimal management versus being a landlord. Um, Now there's tax differences. Of course, we all understand that owning a
Hmm.
renter, you have a lot of tax deductions and so forth. But
Yeah.
the majority of the notes I own personally are in my IRA, so that doesn't matter at this point. But staying focused, and also keeping an eye on the future and looking at trends, macro trends, in our economy,
Hmm.
in the U.S. economy, and what's going to happen possibly in 2 or 3 years. You know,
Hmm.
real estate goes up and down in value, and so trying to figure out where the peaks and valleys are and
Hmm.
anticipate them through research. I read a lot in the morning. I get a lot of news feeds and newsletters. My morning starts out after I take the dog out in the yard is to come back in, have a cup of coffee. I have a little Android tablet, and all I do is sit and read and go through my email, sort things out, get on newsletters, get on a news feed, and read what's going on in the country and the world, so I can kind of keep a perspective in
Yeah.
my little hovel of my home here. I mean, when you work for yourself, my first company, I had 5 employees. We had an office and all that fun stuff. And
Hmm.
I've decided I don't want employees. I don't like office politics. I'm not a good manager. I micromanage too much. So I've learned that in my world, I'd rather work for myself and contract out or take on partners like I have.
Hmm.
And also having the internet and all of the online experience now allows any of us to work anywhere in the world with anybody else. So
Hmm. Yeah.
I have two of my partners are in Seattle and San Francisco. The other two are in Austin, Texas. I've done JVs as probably as you have, and
Hmm.
Chris has,
Yeah.
with people all over the country. So, but
I think
staying
I
focused.
read in your little, I'm sorry to cut you off. I read in one of your pre-interview answers that maybe you hadn't met all of your partners in person. And
That's true.
Chris and I have never met either. We're, running a fund together, and we actually just announced that we're opening a servicing company together, but we've actually never met in person either. And, we plan to, probably will very soon, but it's amazing what you can get done. I mean, in this, with Zoom and, and with technology. Is that true? You haven't met all of your partners?
Yeah, I mean, well, Josh and Scott and I met when they wanted to start the fund. They actually hired me as a consultant to help them design it. So they came up to Seattle and we spent 2 days together.
Hmm.
I also met, of course, Kevin and Ben, my other two partners. But on my JVs, unless those partners came to a conference that I was attending, I might meet them
Hmm.
at a conference. It's interesting to
Sure.
get a call and go through the whole JV process and go out, get together on a project through the phone, and
Hmm.
then go to a conference and they show up and you can actually sit down and have lunch and meet
Hmm.
and do a face to face.
Sure.
So it's an interesting thing, and having a good reputation for being a transparent, honest, deal maker, I guess, helps a lot because I mean, you think about it, when you have a joint venture partner who may be contributing 50 or $100,000 into a project and they've never met me live,
Mhm.
that's a lot of trust we put in,
Sure.
you know.
Absolutely.
And you know, we have our bad actors in the business that have not
Mhm.
performed well, and we know who they are. So you know,
Mhm.
we just try to spread the word to other people as to who you can trust and who you should trust.
Yeah, I mean, let's be honest, for the most part, the note space in particular is a fairly unregulated space. And therefore we need we need to kind of self-regulate and self-police. And I think you know, your reputation is paramount to having success, at least long term. So yeah, I couldn't agree with that more. So just to circle back on, I'm just curious what you, as far as your news or sources of information, you know, I don't know if this would be a good note and bolt to give the listeners. We normally wait toward the end of the podcast, but what type of outlets do you listen to or read as far as trying to gather information on the market, you know, market conditions and economy and that kind of thing?
Yeah, gosh, I'm trying to remember now. I get in our National Real Estate Investor, I think they have a commercial, a once a week commercial newsletter they put out. They just talk about the status of various sectors, which is great. On podcasts, I listen to real estate news briefs with what's her name here?
I put you on the spot, didn't I?
Kathy Betke.
Okay, yeah, I know who you're talking about. Yep. Yeah.
There. But Kathy does a daily, like 10-minute kind of overview of various aspects. And it's so nice just to get a little chunk of, and she focuses mainly on residential and mostly on rentals, and a lot of California news, which none of us really care about maybe, but she has good perspectives. It's a good little news feed. And I also listen to podcasts on Amazon businesses and cryptocurrencies. And so, you know, that's why I have a dog, is I have an excuse to take the dog for a walk, put on my headset, listen
Right.
to something for the next 20 minutes to an hour. Yeah, generally I've signed up for newsletters. I sign up for a lot of newsletters. Then if it doesn't have the kind of content I want, I just unsubscribe. So, you know, I'm always trying to suck in information through reading, through podcasts, getting on webinars, recording. You know, I try to record the webinar so I can watch it at my leisure, or hopefully they have a recorded version. So, and then of course, once this COVID thing dies off, hopefully soon, we start going to conferences. I find that's a huge value for networking, for finding partners, for finding mentors, for mentoring. You know, it's just nice to be able to press the flesh. I don't really enjoy traveling as much anymore because, you know, for obvious reasons, the airlines aren't exactly comfortable anymore. But
Right.
To me, that's a good resource as well.
Yeah, absolutely. We were speaking briefly before we hit record that you and I actually met in early 2018 at Paper Source, I met a lot of. I was pretty brand new to the note space, but I can tell you that just, you know, that experience as a whole that weekend was really valuable for me, you know, just to kind of get inspired and learn about all the different facets within the note space that, you know, that people take. And I definitely think I agree. I mean, you're not gonna, a weekend like that, you're not gonna drill down into the weeds as far as, you know, how to, you know, run a note business per se, but I think just the networking and just the inspiration, and there's a lot of benefit to meeting in person if it's safe. But so, and now you touched on it a little bit, but where are you today with both real estate and notes? What's your portfolio, or what's the future look like?
Yeah, well, in 2018, we actually sold our fourplex. We had, it was cash flowing nicely and appreciating, but our ambition, my wife and I, our ambition was to possibly purchase an apartment or flat in Europe somewhere, maybe in France or Spain, and then Airbnb it and have a place to live if we want to spend a month in Europe and travel around. We love to travel. So we decided, property values were going up, and I thought, I should probably put it on the market. So I kind of did a FSBO, for sale by owner. I think I put it on some lists locally in the Seattle area. And we had actually a guy who was a retired fireman looked at it and then kind of passed on it. And then about 9 months later, he contacted me, and he had a 1031 he had to get done. He sold his other apartment that he needed a 1031, and he couldn't find anything. So he ended up buying mine directly from me. So I didn't have to pay a broker. They're 6%, and we sold it, got our cash out of it. And then we were going to go to Europe last year in May, and then COVID hit, so we had to cancel that whole thing. So we're just waiting we hopefully will be able to go back out to Europe next year. So we sold the fourplex. We still have our duplex. I refinanced that. I'm still buying notes off and on. I'm fairly well connected now, so occasionally I'll get some like a seller carryback, a couple out of Boston. Had 2 seller carrybacks in Birmingham, Alabama, and I bought the notes at a good discount from them. One of them is non-performing, the other one is semi-performing. So, and I bought a note on a HECM, home equity. I forget what HECM stands for, but it's a reverse mortgage.
Okay.
Borrower passed away. I bought a half a dozen of those 2 years ago, where we would either contact the heirs and they would sign over the property, the deed to us, or we would just foreclose because the borrower's passed away, the property's vacant. And so we went through 6 of those over the past 2 years, and I bought this one. It's in near Houston. We're foreclosing actually next week, I think, and then I'll probably just put it on the market as an REO and sell it to an investor. So but mostly I've been I have passive income from some of the JVs. Some of the JVs we did a foreclose and resale. We foreclosed on a property, one partner and I, in Oklahoma City last year. We're gonna just sell it as is, and then a realtor who I've been working with in that area for years, she had a investor who wanted to buy it from us and fix it up and flip it. So we did a seller carryback note for that flipper, and we just got it. We got paid back last month on that. She finally sold it. Well, in the market anywhere, if you have a decent property, it's going to sell pretty quick. So
yeah. So are there any? You mentioned several different states. Are there any states that you over the years have either targeted or shied away from, or is it more a matter of just what comes your way?
It's the New York, New Jersey. I'm not going to touch anything there for foreclosure periods, and I don't know the market very well anyway. In Resolution Capital, we bought a note in New Jersey, and by the time we got to take possession of it after years of waiting for the foreclosure, the neighborhood went down and the value of the property went down 40%, and we lost money on that property. So a good case in point not to invest in New Jersey unless you know market well. I like Oklahoma. I like Tennessee. I like the Carolinas, obviously Texas. I'm staying out of California just because the foreclosure laws and the tenant laws it's just so consumer friendly. It makes it difficult. Washington State is very similar to, I see occasional properties here or notes here. I foreclosed on a few properties in Washington State, but again, a lot of the stuff that's in the higher value markets like Washington or California are going to have a lot of hair on them. There was a note I was looking at to purchase, and then I realized the statute of limitations in Washington is 6 years, and this note was beyond the statute of limitations. It would have been pretty much worthless. So you got to look out like that. But anyway, Ohio, I kind of stay away from. I do like Michigan, Illinois, Indiana, mostly Midwest and Southeast is kind of my
sure. Yeah, makes a lot of sense. I think that's one of the things a lot of brand new note investors really underestimate is how state dependent this whole note space can be as far as the foreclosure timelines and costs and just everything is, most things in the note space are very much state dependent from what I've found.
Yeah.
Certainly in the
also now
first space.
Yeah, and the licensing requirements now,
Right.
Pennsylvania, we had a handful of notes in the notable fund in Pennsylvania, and they now have their licensing requirements, which is it's, from what I understand, it's a lot of work. You have to go to class, and so we're just selling those notes. We're just not going to get licensed. I have a note in Georgia. I think Georgia's got a 3 note limit or something now.
Yeah, so I have there's a mortgage lender license, which is, it depends who you talk to. Obviously, none of this is legal advice from Bob or me, but I have read that as well, the 3 note limit. But yeah, the lender license in Georgia it's not difficult to get necessarily, but it's expensive because you've got to get surety bond, which is required for the license, and then the license itself is $1,000 or $900 a year or something like that. But again, seek legal advice and all that, but it can vary wildly based on the state as far as the laws go, for sure. So so you're winding down your one fund, and then your fund with Josh, that's going strong still?
Yeah, it's strong. We've actually stopped taking on more capital because, again, even in the second position space, it's drying up. The good deals aren't there anymore. So I actually raised a $500,000 in December into the fund, and then Josh said, I can't deploy this, and we had to hand the money back.
Wow.
It's really hard to give money back, but
Sure.
we're not going to sit on capital that's not earning a return, because it just then dissipates our other investors' returns. It dissipates the preferred. So we've kind of just we're sitting on what we have, and we're redeeming some investors if they want to redeem now and take their capital and go do something else. And I'm just kind of sitting tight myself on note investing until I see where the post-COVID real estate market goes. But it's out here in the Seattle area, it's just crazy. There's a house I live on a hill, and I'm 4 lots back from the Hood Canal, which is a waterway. And there's a house right below us with a view of the canal like we have. It's a 4,000 square foot home. They just listed it for $999,000, which just blew me away. It's a big house, but $1 million house right next door to me. It's too crazy.
Well, hopefully for you that it sells for over asking, right?
Yeah. I mean, we're not going anywhere. We just put a new roof on the house, new deck, new windows. So we just improved our house. I spent 10 years improving other houses, flipping, and while my deck is running away and my roof is starting to leak. So after we sold the fourplex, we took some of that capital and put it back into our house. So we actually got an air conditioner now. So
nice.
In this part of the country, you really don't need it. It gets hot maybe in August for a few weeks, so you put up window fans, but we ended up getting a heat pump, and it was a good idea because about 3 weeks ago we had 115-degree temperatures in Seattle. We had this weird once in a 1,000-year heat wave came through.
Yeah, I read about some of that in up in your area. That was wild. I'm curious too. You mentioned joint ventures. When you did your joint ventures, or I imagine it sounds like you still have some ongoing. Do you do them on a per deal basis, or just curious if you could touch on how you've structured your joint ventures?
Sure. Yeah, what I do is I use a personal property trust framework, because notes are not real estate, so you wouldn't use a land trust. You would just use it's personal property. So I purchased a template system from an attorney out of Colorado. I can't remember the guy's name right now, but he had basically a course on how to structure personal property trust, how to set up the trustee and the beneficiaries, and then how to do addendums to change the beneficiary of the trustee. So I learned all that about probably 6 years ago. And so each project has myself or my self-directed IRA as a partner, and then my partner is either an entity or themselves or their IRA. We then execute a joint venture agreement, essentially a partnership agreement. I had one written up by an attorney. It's about 14 pages. It covers, what happens if one of us dies, if one of us wants to buy the other person out, how you evaluate the asset, that kind of a thing. So we execute that. Then I set up a personal property trust for the actual asset, which would be a loan or distressed debt mortgage. And the beneficiaries are the two partners, however they structure their thing. I've been using my solo 401k as my partnership, so I get my income tax free through the Roth component. And then I set up a separate bank account. I get a federal EIN number under a trust, so we have a taxable tax number. And then I go to the bank, set up a bank account. My local bank, the first few times they're like, didn't understand what a personal property trust was. They thought it was a family trust, and they tried to drive me to their trust department. I said, no. So it takes a while to get your bank educated as to, and I like to use a local bank. I'm using my county bank, not Bank of America, not a Big Five. So once that's set up, then my partner funds the deal. I put in at least $100 of my own cash, just so that my IRA can legally invest in the deal.
Okay.
And then I'm using a platform called Insightly, which is similar to Podio and some of these others. Where I can put the deal on that platform, get my partner's email contact in there, and then we can share information via Insightly, and I can track the profitability of the income, expense, and all that. I have a virtual assistant who basically runs the Insightly platform for me. And then she also sets up a spreadsheet to track the income and expenses on the project. And I can share that on Google Drive with my partner, so they can see at any time where I've spent the money, where we've seen income. And then if assuming the project goes into a performing note, then the principal and interest comes into the bank account. Diana then posts that to the project, and then every quarter I do a distribution where my partner gets 100% of the principal and 50% of the interest, and then my solo 401k gets the other 50% of the interest.
Okay, interesting. That's more complicated maybe than some JVs that some people do, but I think again, seek legal advice, but there's nothing wrong with doing joint ventures. I think we've had maybe a little bit of interaction on one of the Bigger Pockets forums about, somebody asks, are joint ventures legal? And it's like, well, yeah, they're legal if you do them legally, and if you do them properly, whether it's on a non-performing note or whether it's on a fix and flip, it doesn't really matter. Yeah. But that's really interesting. I've never heard. I think I've heard a little bit from you before on how you do that, but that's pretty interesting. So is it typically on a one asset that you're buying per when you say a project? Is that one asset typically?
Yeah, it's one asset, and keeping everything firewalled. In other words, don't commingle different partners. I have separate bank accounts. I mean, I had literally 20 bank accounts, 20 separate JVs, and 20 separate partners, and 20 separate agreements. And with technology, it's not that hard to manage all of that. And now I'm down to about 6 JVs that are creating cash flow from performing notes. The rest of them were either foreclosed and sold, and we dissolved it or whatever. But keeping everything separate, because if you commingle and something goes sideways, securities regulations, that would be pretty much a no-no to do. Unless you're running a fund and you do it on a fund basis. But
right.
So yeah, I overdid it, but I overdid it just to keep everything safe and make sure our partners' equity, their principal and their investment was covered and separated from everybody else's.
Yeah, that's good reasons to overdo it if you're going to overdo it. Did you ever get into selling partials or anything like that, or not so much?
No, I talked to my partner in my cousin and my wife and my IRA are partnered into an LLC, and we've been buying notes in there. We talked about doing partials, but we're getting a good return on them. So why
Mhm.
partial? We
Mhm.
don't really need. In fact, we're cash rich now because we had one of our loans paid off that we've had in the portfolio for the past 8 years, and so we don't really need the cash.
Mhm.
So to me, partials, I understand them. I can see
Mhm.
how they work, but
Mhm.
don't need to
Yeah.
do them.
And that's, I mean, you're hitting on what, one of the things I love about real estate and notes is just everyone's situation is different. So go with the approach that makes sense. If you're cash rich, why would you sell partials right now?
Right.
Um, almost sounds like you would rather put that to work and have more cash flow as opposed to a
Exactly.
larger lump sum of cash. But yeah, that's what I love about this whole space is you can go, be creative and solve whatever problem you have, based on your own circumstances. So if you're looking back on kind of, your real estate career, it's note career, small business, any of it, what would you say is maybe one or two mistakes you've made that you've learned from, or you could, impart wisdom from to our listeners?
Yeah, it's one thing I've learned is I'm not going to buy a note on a condo in Florida.
Okay.
Especially in the Miami area, it's kind of a shark pit. I mean, if I know, we know a few investors who are big in Southern Florida like that, and I forget Bill Blymel, and I kind of spoke to him a few times, but I did buy a note on a condo in the Miami area a few years ago with a JV partner, and it went very sideways. Um, the the problem was I didn't realize that there was a mandatory country club fee when the property
Mhm.
changes hands,
Okay.
and the fee
Interesting.
was $70,000.
70,000.
70,000. Yeah. And that pretty much destroyed the value of the property and the
Wow.
investment we had in it. So
Wow.
it was and the HOA fee was again another 1,200 a month. I mean, it's very expensive, and these
Mhm.
HOAs are happy to foreclose on their own condos so they can flip them out. So you're competing with the HOA sometimes.
Mhm.
To me, it was just too much of a snake pit, so we exited
Mhm.
that at a loss.
Mhm.
And again, in JV, when we were splitting income and I'm getting profit, I also split losses. So I had to kick in 50% of my self-directed money into
Mhm.
the loss to get the thing
Mhm.
exited.
Oh, that
So that
sounds
was,
painful.
yeah. So, keeping an eye out on HOAs, if you're going to buy notes in a condo situation in any state, definitely check HOA fees and country club fees, things like that you might get blindsided on because you're only used to single family homes, and those things don't really
Mhm.
impact you.
Sure, that makes sense. No, that's a really good one. So, how about looking back? Anything obviously you've done a lot of things well, but anything that kind of comes to mind as far as your biggest strengths or successes?
Well, I mean, yeah, in notes, one of the first notes we purchased in our IRA LLC was on a little house in a suburb of Charlotte, and yeah, this was probably in the first half a dozen notes, the first two or three, and I bought it. The property value of the house was at the time was maybe $35,000. It was a little two bedroom, 1940s,
Hmm.
900 square foot house, and we paid 13,500 for the note. It was already in foreclosure. Um, and long story short, we worked with the borrower. We told him if he can come up with $10,000 down, we'll modify his note, re-extend it for another 30 years, blah blah blah. And
Hmm.
he basically was, trying to get us to not foreclose. He told us that the house had a sewer backup and all these great excuses. And we
Hmm.
just held our ground. And then a week before the auction, he finally came to the table and wired in 10,000 into FCI, and we, put the foreclosure on hold. And anyway, we ended up getting our capital, our core capital back probably within 18 months. And we still have that note, and the property's now worth like $96,000. So,
Wow.
we're getting cash flow, for the past whatever 8 years now,
Hmm.
at 100% return. And if he ever wants to stop paying his note, I'd be happy to foreclose on the house now. That was a
Yeah.
nice little
So,
home run.
right. So I guess, buying right, Chris and I talk about what's more important, buying at the right price or asset management. Kind of, I don't know if there's a clear answer. If you overpay for a non-performing note or any note, then you can't really asset manage your way out of that one, if you
Yeah,
will. But you also had to be patient and diligent and hold your ground, it sounds like,
yeah,
with
yeah.
dealing. Mhm.
Yeah, like that New Jersey note. I mean, if we would have kept it in the portfolio now, maybe that property probably swung back up in value. I haven't looked at, what its value is, but
Mhm.
being patient, and also looking at trends and things,
Mhm.
when I was flipping homes, I'd occasionally get into a situation where, I was borrowing hard money at 1% of the 1% a month payback.
Mhm.
And so when you're flipping a house, where do you set the price at? Well, you want to set it at the highest price you can get for it, because you want to suck out
Mhm.
all that equity. But then if
Mhm.
you price it too high, then it sits on the market for 60 or
Mhm.
90 days. In the meantime, you're paying that 12% interest on the note there, and it's eroding your profit. So finding balances between what you pay for an asset, when you want to liquidate, what's your long-term plan, and have 2 or 3 exit strategies in place so
Mhm.
that you're not forced into exiting at a loss, particularly if you can maybe
Mhm.
say, we could have kept the house in New Jersey, fixed it up, and then sold it as a rental maybe or something too. I mean, there are other things, but
Right.
we just wanted to exit, get at what capital we could back out of it and redeploy
Yeah.
that money,
Yeah, and it's so you never know. You don't have access to the results ahead of time, so
Yeah,
you can't second guess too much. There's an art and a science to it. But you're right. The time value of money, putting that capital back to work, is a critical piece of things if you're looking at it from a portfolio perspective and not just one deal.
yeah.
Um, that makes a lot of sense. Now you said earlier you told me you're working on an Amazon business. Is that right? Did you want to briefly talk about that?
Sure. Yeah. So last year, I kind of, we see the trend that distressed debt is drying up. The stockpile of toxic assets has been cleaned up pretty much. So finding value and opportunity in the note space to me was starting to become more of a challenge. And
Hmm.
because I have an IT background, for the past 20 years, I started to do some research on where do I want to invest in, what do I want to do now, and I realized that taking on an Amazon business or selling on Amazon can be lucrative. Like any other industry, there's the gurus who tell you you can make millions and all that good stuff, which
Sure.
it,
Right.
so I ended up looking around. There's brokerages that actually will let owners of Amazon businesses sell their business. And most of these brokerages are pretty high end. I mean, these companies are being sold for the multi-million dollar and a 3 or 4x annual net profit income. So those are out of my league. But I did find a mom and pop business who has been on Amazon for 10 years, which is good, a well-seasoned business, and they basically sell pet supplies, collars, leashes, beds, carriers, that kind of thing.
Hmm.
They had it priced reasonably. I think they had it priced at about a 1.5x of net profit, which tells me that I can recoup my money within a year or two, or one and
Hmm.
a half to 2 years.
Hmm.
So I went through my due diligence with them, made an offer, they accepted it. So a year ago from June in 2020, I paid them for the business, took over their Amazon account, and also they had a web store as well, which I moved over to Shopify. And I have a Shopify store now in my Amazon business. And then I hired a virtual assistant out of the Philippines and she handles my order processing and does some customer service. Mainly it's just messaging through the Amazon system. So I've been doing that now for the past year plus, as well as still buying some notes and co-running the fund with my partners and all that. So it
Mhm.
gets a little hectic sometimes, but with Resolution Capital winding down and Notable Capital settling in,
Mhm.
I have more time to dedicate. I just actually bought another Amazon business. I'm actually buying it right now.
Oh, wow.
The guy, basically, it's a guy in Austria. He's Romanian but lives in Austria with his wife and daughter, and he built a one product Amazon business. He sells a silicone, um, 20 by what is it, 14 by 20 mat with tall lips that you put your dog bowl or your pet food bowl on, and it
Hmm.
keeps the spilling over to get on your carpet or your hardwood floor.
Okay.
It's just a mat. It's $14, but he's doing well. He wants to sell it, so I'm buying it. I'm just going to add it to
Okay.
my product line. So
Interesting. So a couple of things jump out. Well, first of all, what's the name of your business?
on Amazon, it's Southpaw Pet Supply.
Okay.
And then my Shopify store is theluckydog.store.
Okay. And secondly, I was going to say, I don't know if this is true, but it seems like you timed it well with
COVID,
with
yeah.
COVID. I definitely saw some articles, about the number of dogs, number of pets increasing for sure. Is that true?
Yeah. It's true, and yeah, it was a good year. And I'm also reading articles now that the shelters are getting a lot of pets because now people are going back to work. They can't
Mm,
hang out with Fido anymore, and it's really sad to see them having to turn pets in.
hmm.
Um, and business is still strong. It's interesting to see that, in October, November, I started to get a lot of orders for pet carriers. I'm going, why? Oh, everybody's going to be traveling for Christmas. Starting to see
Ah,
people traveling now, and now
interesting.
we're selling. We sell a pet vest that has straps in the back, and you can run a seatbelt through it, so you can keep your pet safe in your car. And
Hmm.
those are really popular right now because people are driving again. So it's interesting to see these trends happening
Yeah,
in this little niche.
yeah, that's pretty cool. I mean, so many takeaways from this interview. I mean, one for me is that um, like we said, you focused on one thing at a time, but then you've kind of developed expertise across many different, niches and asset classes. And then when the market, but you're also paying attention to market trends and the big picture. None of us can predict what's going to happen exactly, but when it does happen, you're going to see maybe some signs and then also be able to pivot, and fall back on one of your strengths or something that you've been learning over the last year or two. So I just love the kind of the growth mindset and a lot of key takeaways. I think our listeners are going to get a lot of value out of this. But is there anything else you want to kind of mention or anything that comes to mind?
Um, no, I've been looking at other opportunities. I found I started to latch into buying music royalties. There's a
Hmm.
couple of brokerages that sell music royalties now, and it's mostly rappers and bands I've never heard of. But you can buy the way that music royalties work is the artist gets a certain percentage over the life of the music, the album, the song, whatever it is.
Hmm.
And typically in the first year to 2 years, they get 75% of the income off the royalty, and then it really tapers down. So a lot of times they'll want to sell either the lifetime rights from that period going forward, or maybe the next 10 years, and they want to get that cash out, So these brokerages are selling royalties. You get paid directly from EMI or whoever the music publisher is. So it's pure passive income, which is an interesting model.
Hmm.
But it equates to about a 10% annualized return, and I'm going, it just doesn't no
Doesn't
fun.
do it for me.
Not when you're buying notes and making 20, 30% sometimes, although it is totally passive. You're just getting checks, you don't have to lift a finger. But
Hmm.
it's fascinating to see how people are bidding on music royalties and all that. So I'm kind of
Interesting.
exploring other investment things, but I
Okay.
still like real estate the best, and my goal with my Amazon business is to increase the cash flow and the net profit over the next 2 years and try to sell it for a higher multiple and exit. And maybe
Okay.
then we'll have other opportunities, real estate. Who knows?
What does your wife think about all does she get involved in any of these strategies? No.
No. So she understands exactly what I do, but I bounce ideas off of her, and what do you think of this? And so we work together in terms of conceptualizing and planning, but
Mhm.
she doesn't have the patience that I do for the business aspects of things.
Mhm.
More of a
Yeah. It's just always an interesting dynamic, and we can talk about investing in notes, but the reality is there's usually some kind of family dynamic or home dynamic that could Chris's wife, for example, we joke that she it's a little hobby he does in the basement, but meanwhile he's managing he's got a portfolio of, I don't know, 300 notes or something like that, and a full-time job, and but it's just his little hobby in the basement. But my wife was helping me. We do some real estate stuff together, but she was helping me a lot with our note business, but she's not doing that so much anymore. But every situation is different, so I was just curious.
Yeah, and the rule of thumb for me is having a spouse who is understanding and patient and can roll with the environment. Because when I was flipping houses, there were a few years where we were not doing well financially. I was over leveraged, and we were cutting back on a lot of stuff. So, and my wife Suzanne just hung in there with me. She's been self-employed for 20 years herself, and so she knows the facets. But having that up and down in terms of cash flow and sticking together through the lean times, it's important that your partner understands that there's risk there, and
Sure.
trust me that I can mitigate the risk and make us money. But if I screw up or if I miscalculate, don't walk out the door. Stick with me.
No, that's a really key point. I'm glad we brought that up, because it's easy to talk about the wins and the glory days, I guess, if you will, but there definitely are ups and downs, whether it's with any kind of small business or investing venture, I think. So if you know that going in, then you don't necessarily know what it's going to look like exactly, but you realize, okay, I knew that there were going to be some hard times, and here we are. So,
and it depends on too. I mean, a lot of investors have a spouse who works full time, so they bring in, the mortgage money and the food money, while the other spouse takes risks and maybe doesn't make as much money. But for us, we're both self-employed, so we're
it's extra pressure at times, maybe. Gotcha. Okay, well, Bob, this has been really, really great. I really appreciate you joining us today, and I know our listeners, like I said, are going to get a lot of value from this. Where can our listeners reach out if they want to reach out to you?
Probably through Notable, Bob at notablefund.com, and Notable Fund is NOTABLEFUND.com. So that would be a place to go. I'm on Facebook. I'm also on LinkedIn as well under Bob Malecki. So feel free to reach out to me. And
Bigger Pockets as well.
And Bigger Pockets. Although the traffic going through Bigger Pockets, I've noticed, has died down quite a bit in the
Yeah, I agree. I've been less active myself, but yeah, it definitely seems to be a little less active. I also got my wrist slapped for self promotion or something. I think you've had that before, but
I got suspended 3 times.
I think you told me that back when we met in 2018.
They're very strict on that stuff, and actually the second suspension was how I got a hold of the owners, with 2 guys, I can't remember their name, and that's how I got interviewed by them on my
okay. Josh and Brandon, maybe, or
Josh and Brandon.
Yeah. So something good came out of it, I guess. That's good.
Yeah, that's for sure.
So, okay. Well, thank you very much once again, Bob. This has been great. I really appreciate it. And, like I said, I know our listeners are going to get a ton of value. Thanks a lot, Bob, for joining us. And
You're very welcome.
for our
Yeah, thanks
listeners
for having
out,
me.
yeah, absolutely. And for our listeners out there, feel free to give us a positive review and go out and do some good deeds. Thanks, everyone.
All right, take care.